AMC stock alert. There are 0 AMC shares available to short. Fintel reports that there are currently 0 shares of AMC left to short. At the same time, AMC's cost to borrow fee has more than doubled since March 13th, and AMC stock is up 10% year to date. We're going to get into this article as well as this other article saying, what does AMC stock have to do with the collapse of Credit Suisse? This is all very interesting and we're going to get into it. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you have not already. So, according to Fintel, there are 0 shares of AMC Entertainment left to short at the time of writing. Yesterday, the number of shares available to short hovered around 10,000. At the same time, the cost to borrow fee for AMC stock has increased to a significant 214%, and this is per Interactive Brokers, up from 166% a week ago and 103.55% on March 13th. Generally, a cost to borrow rate above 10% is considered high, while a cost to borrow rate above 20% is considered very high. Since March 13th, shares of AMC are down by about 18%. The cost to borrow is the yearly fee that short sellers pay to borrow stock. The fee rises when short seller demand is high and falls in line with a decline in demand. A high cost to borrow could also signal a scarcity of available shares to short, which is exactly what is happening right now. Available shares of AMC stock to short falls to 0. While a high cost to borrow conveys high short seller demand, it can also be perceived as a positive for long shareholders. No short seller wants to pay 100% annual interest for borrowed stock, much less 214%. In addition, a higher cost to borrow lowers the chances that a short seller emerges profitable. This could ultimately influence the short seller to sell out their position by buying the underlying stock. With 0 shares available to short and a high cost to borrow fee, it's apparent that short seller demand for AMC is high right now. Meanwhile, the short sellers have quite a bit of ammo to use in their thesis. Earlier this month, shareholders of AMC and AMC Entertainment Preferred Equity Units, APEs, voted in favor to approve a reverse stock split and increase its authorized shares for AMC. The approval of these 2 proposals will allow AMC to convert all shares of APE into AMC stock. Still, the conversion is pending on the hearing results of preliminary injunction motion set for April 27th. Though 2 punitive stockholder class actions, shareholders argued that AMC votes should have not been included to approve the 2 proposals. Another bearish bite came from Citi, which resumed coverage of AMC yesterday with a $1.60 price target. Analyst Jason Basnett believes that AMC would need to increase its share count by between 77 to 230% to pay off all of its debt. And the interesting thing about this, if you have not heard and you don't remember from previous experience, every time AMC has actually raised capital, the stock has rallied. So I wouldn't think of it as necessarily a negative thing. I like to think of this as a win-win scenario. One, there's a lot of shorts that are short on AMC that otherwise would not be short on AMC if this reverse stock split and share authorization, this vote wouldn't have happened March 14th. And if it does not pass the court system, well, you ultimately get a lot of shorts caught off sides and on the wrong side of this trade. And you can see this prevalent in the cost to borrow rates, and that will continue to squeeze these shorts more and more. On the other side, if this does go through and AMC does raise capital and get rid of its debt, fundamentally that improves the business. And if they can make it to a place of profits, well, every time you have seen AMC dilute its shareholders, the stock is rallied over 100%. A lot of times 200 to 300% rallies in AMC from the lows to the peak. So I do think inevitably that will give you a rally in AMC stock. So I think that is pretty important to point out for everyone. Now, what does AMC stock have to do with the collapse of Credit Suisse? Not so long ago, Credit Suisse predicted that AMC shares would reach less than $1 per share. However, the tables have turned. Here's what you need to know, and quite literally, Credit Suisse is now under $1. Swiss bank Credit Suisse collapsed over the weekend and will now be acquired at a discount by rival UBS. Credit Suisse analysts had rated AMC shares as a sell and expected the stock to reach below $1. Credit Suisse chairman blames social media and retail investors for the swift downfall of the bank. And it goes on to say that Credit Suisse is really just a problem child for a long time. Their shares are worth less than $1. In 2021, Credit Suisse was one of the banks involved in the Archegos capital management scandal, which caused it a $4.7 billion loss. Credit Suisse was also the lead investor in the failed Greensill Capital 2 years ago and was involved in an espionage scandal 5 years ago, along with other troubles. Now, rival bank UBS is set to acquire Credit Suisse at a hefty discount. What Credit Suisse's chairman just said. This week, Credit Suisse chairman Axel Lehmann, doesn't that name ring a bell, was asked about reasons behind the bank's collapse. His answer was surprising. According to Lehmann, not only had the bank been overcome by risk, but it was also affected by an outdated business model. He pointed out that the bank's customers had been loyal for quite a long time. However, since last autumn, a social media storm has targeted Credit Suisse, shaking the confidence of its investors. Fox Business journalist Charles Payne tweeted that Lehmann deserves to be nominated for Clown Ass of the Year for that statement. Charles Payne, you gotta love him, all right. Now it says, when Credit Suisse poked the apes last October, and it goes on to say, rated AMC as a sell and a price target of 95 cents. Credit Suisse's main problem with AMC was the company's lack of profitability, according to Credit Suisse. Even if attendance levels were to return to pre-pandemic levels, AMC would still need to see healthy returns on its balance sheet. Apparently, the Swiss bank wasn't counting on this happening. Credit Suisse's position on AMC has been interrupted by many individual investors as a case of the pot calling the kettle black. At the same time, Credit Suisse itself was worth less than $4 a share and was already showing signs of approaching penny stock levels. With Credit Suisse's business already in turmoil, many in the market started to question its survival. Investors began to turn their attention toward the rapid decline of Credit Suisse and, of course, its potential spillover effects. The bank reported steadily decreasing revenues, losses from its Russian business, and also litigation costs. This forced the bank to drastically reduce its headcount at the end of last year. Today, Credit Suisse shares are worth less than $1, while AMC stock trades for nearly $5 per share, baby. The bottom line, the collapse of Credit Suisse didn't happen overnight, nor did it only have one cause. There was an accumulation of factors that had already been weighing on the bank's outdated business model, along with many bad strategic decisions over the past years. Perhaps the final blow came when retail investors on social media platforms scrutinized Credit Suisse's reputation. This possibly impacted the abrupt collapse of its share price. It's not hard to understand why many retail investors root against financial institutions like Credit Suisse. Even last October, when the social media storm hit Credit Suisse shares hard, company executives issued a memo telling employees not to confuse stock performance with the bank's capital strength and liquidity. Since 2021, we've probably seen the most speculative stock market in history. The negative exposure of Credit Suisse on social media was just the icing on the cake. And it's very interesting how Credit Suisse actually collapsing is going to affect AMC, and it could affect it quite a bit, because after all, look at who they are involved with. Archegos, number one, they were like the first ones involved in the whole meme stock situation, and really boosted up a lot of stocks like Paramount. Remember, that stock went from like $20 a share to $70. Yeah, that was Archegos, right? And a lot of other stocks that they were a part of, Credit Suisse was behind and took massive losses on. Now, that's not to say it's apples for apples here. You don't really know, and we probably won't know for at least a couple more days or a couple more weeks exactly the implications of Credit Suisse going bankrupt will have on AMC, but I would imagine it's positive because at that point investors are going to have to really pull their capital out of whatever loans they have with Credit Suisse, especially now that UBS has bought Credit Suisse. They're not going to want to be a part of that either. So I do think this is a positive tailwind factor for AMC, and the story is only just beginning. So that is it for this video. A nice short sweet video for you guys on this sunny cold Sunday afternoon, no pun intended there. That is it. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you have not already. I don't know what you're doing. It is free 99. Thank you guys for doing that. That's it. You guys enjoy the rest of your Sunday, and I will see you in the next one.